Econ 302 students, I'll be walking through the slides related to Chapter 2 now. These slides were produced for your textbook. I've made some changes to update some of the data, and I will talk about some of my own thoughts regarding these facts, these slides, as we walk through them, so you get a little bit bigger of a picture of it. Chapter is about the meaning and measurement of macroeconomic statistics. The most important ones are GDP, the gross domestic product, the consumer price index, the CPI, and the unemployment rate. We begin with GDP. There are two ways to look at GDP, through expenditure or through income. So there are two definitions for GDP. The total expenditure on domestically produced final goods and services is one definition. The other is total income earned by domestically located factors of production. This makes sense because every dollar spent by somebody is a dollar received by somebody else. So if we're simply tracking legal transactions, then every receipt from a buyer will also be able to be reported by the seller. So the government, when it does its adding up of expenditures and its adding up of incomes, should come out to the same number. However, there are slightly different processes involved in calculating these two statistics, and so there may be a discrepancy between them. The discrepancy is usually small, and it's merely related to the fact that collecting this data is complicated. The circular flow demonstrates the fact that I just shared with you, that every dollar being spent by a household in the bottom half of the circle in the clockwise direction ends up being spent again by firms to pay for the resources involved in production, and that income is received by households. So expenditure money is equal to income money. Also, flowing in the clockwise direction, so the green arrow is flowing in the counterclockwise direction, and that is the money. Flowing in the clockwise direction is the real economy. That is to say, the actual resources owned by households, and it shows labor, but households are also the owners of capital, and are also the holders of land, and are also the individuals who are entrepreneurs. So each of those supplies their inputs into the production process, and the firms then produce goods, which are then in turn purchased by households. One of the tricks to this picture is the fact that everybody is both in a household and in a firm, to the extent that we are both involved in production and in consumption. Value added is important to understand when looking at the income side of the circular flow diagram. The value added is the value of output minus the value of the intermediate goods used to produce that output. So everybody, when they're producing something, has to purchase inputs into the production process. After paying for all of the inputs, once the final product is sold, the value added is the difference between basically your costs and the sale price. I am hesitant about the use of the phrase value added because it seems to imply that the value of the good or service flows from the input to production into the product and then to the consumer. However, it is better to understand that final goods and services are valued by consumers subjectively, that each of us has different preferences in what it is that we want to consume or what services we choose to pay for, and it is our willingness to pay for those goods and services that is a demonstration of the value of those goods and services. If I did not value a good or a service, then I would not be willing to pay for it. If I did not pay for it, then there would be no market for the producer who tries to sell it. So it is important to understand that value flows from the consumer and the value of the service or good in the mind of the consumer down to the inputs of production and not the other way around. Because people for a long time presumed that the value of goods and services came from the labor that went into producing it, they were confused and came to develop what is called the labor theory of value, which is a fallacy of economic reasoning that is still frequently observed in arguments today. It is the consumer who values the final product that imputes into that final product the value of that good or service, and then helps to determine whether there is going to be a market for that good or service. If somebody tried to come and sell me rat meat, the fact that it took them 2 or 3 hours to harvest the rats and then cook them in a peculiar way would not necessarily indicate that those morsels had any value to me or that I would be willing to pay for them. It is because I do value a hamburger that somebody cooks a hamburger and that somebody grinds beef to sell to the person who cooks my hamburger, and that somebody else raises cows that can then be turned into beef for our consumption. The value flows from the consumer to the producer and not the other way around. In this example, we see that a farmer grows a bushel of wheat and sells it to a miller for $1. The miller turns the wheat into flour and sells it to a baker for $3. The baker uses flour to make a loaf of bread and sells it to an engineer for $6. Do we care that the engineer is an engineer? Not even a little bit. It doesn't matter what the engineer does. The person who buys the bread could actually be the farmer. Now, in this example, the final good that is produced sells in the marketplace for $6. So that is the number that will be reported on the expenditure side calculation of GDP. However, the engineer who paid the $6 to the baker gives the baker the money, and the baker takes $3 of that and pays it to the miller. So the baker's value added is $3. The miller takes that $3 and gives $1 of it to the farmer. The miller gets to keep $2 of it. That is the miller's value added, is $2. The farmer grows the wheat, and I suppose we're supposed to think that he grew the wheat with no inputs. That's fine. The farmer gets to keep the $1 that he sold the wheat to the miller for, and that is the farmer's value added. The $1 at the farmer level, the $2 at the miller level, and the $3 at the baker level add up to $6, and that is how we calculate the income statistic related to GDP. They turn out to be the same. When we talk about GDP, we talk about the value of final goods and services produced within a region in a particular period of time, and it's usually the final market value. The value of the final goods includes the value of the intermediate goods, so including intermediate and final goods in GDP would be double counting. We don't count the price that the intermediate goods sold for. We only count the final good when calculating the expenditure method. To further decompose GDP and to try to understand what's actually happening in the economy, we break it down into 4 broad categories: consumption, investment, government spending, and net exports. You can see that we use a different letter variable to identify each of these. It is supposed that the total value of output is equal to the expenditure on each of these 4 categories summed together. We can look more closely at each of these. Consumption is also decomposable even farther. We look at durable goods, goods that last a long time like a car. We look at non-durable goods like food or clothing, although sometimes clothing can last a really long time. Services are intangible items that are purchased by consumers. Services are typically consumed at the point of purchase, or when the transaction happens, it is the service that is being transacted. Durable and non-durable goods can last a longer amount of time. Food is typically consumed the moment that it's purchased. I took the slide that was produced here and updated it using data from 2019, and I'm providing the link there. I strongly encourage you to go to that link and explore for yourself. There are a lot of other little opportunities to explore data collected by the Bureau of Economic Analysis by going to that website. We can see that in 2019, GDP was about $21 trillion, which, if you divide that by 328.2 million people, the population of the United States in 2019, at least as far as Google is reporting it, that would amount to $66,000 per person. So for a family of four, that would be roughly $250,000. Clearly, not every family of four is living on $250,000 a year. There is distribution of that total GDP that is somewhat unequal across society. The consumption component of GDP amounts to about $14.7 trillion, or roughly $44,900 per person. We can break that consumption down into three different categories: non-durable goods, durable goods, and services. Services actually amounts for the greatest portion of expenditures. You can also look at how the total expenditure is broken down per person on the far right column. The next broad category that we break GDP down into is investment, and then we again decompose investment into three categories. Business fixed investment, so this is money spent by companies to buy factories or machines at the place of the factory. Then there's residential fixed investment. This is more or less housing expenditure. And then inventory investment. This is how much goods and services, or typically goods, firms produce that they don't sell within the year. And instead of double counting it, we just count the fact that it was produced this year and held in inventory, so that we get a good measure of production for the year. The inventory investment category here fluctuates probably more than the other categories. So again, we include consumption here so that we have something to compare the investment to. Consumption is roughly 14 trillion, and investment combined would be about $3.7 trillion in 2019. That amounts to roughly $11,000 per person. So investment is a smaller share of GDP than consumption. Next, we look at government spending. The government spending, we don't include in that Social Security, unemployment, welfare, any money that is basically a transfer of money from one set of people to another set of people, or even back to the same people. All of that is not counted in government spending because that would be money that is spent by those people, and we don't want to double count it. We just include money spent by the government on goods and services. Here we see, again, consumption was roughly 14.8 trillion. The federal government altogether spent about $1.4 trillion, and of that, about $875 billion was spent on defense, and $573 billion was spent on things that don't have to do with the defense. Now, this is the federal government's spending, and it does not include state and local government spending. This is just looking at the federal level. You can dig down and look at state and local spending, and if you were to do that, you would find that state government spending is roughly $2.4 or $2.36 trillion. State and local government spending is greater than the federal government's spending. And that makes sense for a lot of reasons. A lot of healthcare expenditures come from the state level rather than the federal level. Roads, schools, most of the amenities that we receive from government are provided at the state and local level rather than at the federal level. Finally, the last category has to do with imports and exports. We calculate net exports as the value of total exports minus the total of imports. And if we look at the next chart, we see that exports were about $2.5 trillion and imports were about $3.06 trillion. So on net, there is a trade deficit of $550 billion. Is this a big number? Not really, right? If you took 550 divided by GDP, which is 21 trillion, it would be a small percentage. So a lot of times people like to get worked up about trade data. It's a small share of overall spending. Okay, output is equal to expenditure because unsold output goes into inventory and gets counted as inventory investment, whether or not the inventory buildup was intentional. We're assuming that firms purchase their unsold output. This is just, again, all this is accounting. And we're just trying to make sure that the numbers match up. So we have to develop accounting rules so that they make sense and are tractable, so that the economist, when they look at the data, understands how the data was collected and what the data can and cannot describe about what's happening in the real economy. It's important to recognize the distinction between a stock and a flow. And the bathtub example is given in the textbook. I recommend that you take a look at that. But a stock is how much of something that you have, and a flow is the rate at which your stock is changing. For example, a person's wealth is their stock, but your income is a flow. The amount of money that you put into savings is a flow, or take out of savings is a flow. The number of people who have completed a college degree is a stock. That's our stock of educated people. The flow is how many people are going to graduate this year, and so on and so forth. The stock here should say the government debt is the stock, and the government budget deficit is a flow. That's how much the government is spending above its revenues any given year. Investment versus capital. Investment is spending or new spending on new capital. So every year when the government spends, or when individuals spend some money on investment, that money is a flow. The amount of capital that exists within the economy is the stock of capital that exists. We have to spend more on investment every year, and the stock of capital does not increase at the same rate as investment because capital is constantly depreciating. So the capital that is already in existence is wearing out. I'm going to stop here and we'll start again on another recording.